Hey everybody, I thought I would shoot a quick video of me talking through the ERC due diligence checklist that I put together. Just because some people might not be aware of what I'm getting at with some of these questions. And yeah, so let's just get into it. So just as a caveat, this is not going to be tax advice. This is just experiences I've had talking to tax professionals about the ERC program and some of the nuances that they might not be aware of going into it. Now, if you want to get a more deep dive on the general parameters of the program and things that I think every practitioner should know, there's a couple of resources, including an earmark webinar that I did that's a 2-hour-long CPE that you can get some continuing education credit for, that describes basically the essentials that I think everybody should know about this program, especially if you're a tax practitioner, generalities about how it works and who's eligible, etc. So if you want that, there'll be a link in here. But again, this isn't going to be tax advice. This is more just a tool for you to be able to facilitate some of these tough conversations that you might have to have with clients around an ERC filing that was done without your consultation, and things that you might want to watch out for. All right, so let's get right into it. So first thing is entity eligibility, because when you're looking at ERC for an entity, the first question is are they eligible for the program to begin with? And if they are eligible for the program to begin with, the second consideration is at what scale do I need to be looking? Because we have aggregation requirements within this program that can change the scale to, instead of just looking at one individual legal entity, you're now having to look at multiple legal entities, treating them as if they're one. And so that's the first core piece that we want to answer. So the first question is what type of entity is filing, because that also will keep in mind for you, what are the income tax impacts, because there's that piece of it as well. So what kind of entity is filing? What's their legal designation? Are they an S corp? Are they a 501c5? What are they? Because the rules will be different for them. And then which quarters are being filed for? Because different entities will be eligible for different time periods depending on, if they're a large employer, if they were a startup business, etc. So you want to look at which quarters that they have that they're being filed for. Pro hint for you, if it's a Q4 2021 for a normal business, that's not going to work, So the next question after that, are they an active trade or business or a non-for-profit organization? And you see the key word there is active trade or business. They need to be an active trade or business or a non-for-profit organization. What are they? You can look for most of these questions if you want the deep dive on if you have an unusual type of entity or an unusual type of business. If you look at the IRS notice 2020-21, that's going to have a whole section on what's eligible entities. And then there was also revisions later on related to like hospitals and semi-governmental organizations. So if you have those, you want to look into the later notices. And so were they a governmental or semi-governmental agency? Because then you'll really want to dive into the specifics of the IRS guidance if they're not just your standard, S Corp professional services organization. Do they have mutual ownership interests in other entities? Because that's a common red flag for an aggregation. If they, especially if you have like a small family group where, father and son own a business here and then they own another business there, and maybe somebody's got rep status and things are being treated as active. Those are things you want to watch out for. And then do they have any active status real estate holdings to be considered? So it's, things you have to consider as well when you're doing the scale of the testing. Does the entity share ownership with other entities or significant management functions with other entities? This is pointing again to the aggregation question, because if they have shared ownership and they have, or without shared ownership, they have the significant management functions that are being shared, you may have an aggregation there and you want to dig in and see, what's the actual relationship between these and do we need to aggregate? Same question with the leased employees, that can trigger an aggregation. Next question is when did they start operations? Because if they were operating mid-year 2019, that'll change how you do your revenue testing. If they started operating after the pandemic started, they could qualify as a recovery startup business potentially. So if they aren't just a bread and butter, was in business before the pandemic all year 2019, they might have a special status, or there's a special way that you'll need to do the testing for them. Did they have over 100 employees during 2019? Now, this is not pointing to the actual rules. This is more just the red flag, right? Because we have specific rules around if you have employers who are classed as large status, how you do the testing to determine that, this is a good trigger. If they have over 100 employees in 2019 flat, then you have to go into testing of, do they actually have enough employees when you adjust for the hours, that they really are a large employer? Are they a large employer for both years? Do they have a significant part-time population of people that we wouldn't count towards the testing? But it triggers you to know, okay, we need to do some testing to see if they should have been a large employer status, which will change their eligibility for the program. And then that second question with the full-time versus part-time. And then, if you have aggregated businesses, you especially have to consider the head count, and then you have to consider those rules. So that's the first part for the eligibility of entities. And then obviously if you have kind of a very unusual business that's not your bread and butter, normal operating business, you'll want to really review those guidelines specifically. So the next test after that, once you've determined the size of the scope that you've got an eligible entity to begin with, then you're going, okay, what time periods are we actually eligible for? They can qualify for this program, but what time periods are they qualifying for? So the first step is the revenue testing, because it's the easiest step. And you're going to want to access quarterly profit and loss statements, just because typically how those are presented, if there's any other type revenue accounts, those will show up on there. If this is a person running it on QuickBooks, it'll show up on the bottom, and other, the other income section, you need to include those in the testing. And then the time period we're looking at is Q1 2019 through Q3 2021. That's the overall time period. Another core piece is you want to make sure that the annualized revenue figures are similar to the income tax returns. So if you run a report out of QuickBooks, but you as the tax professional did a bunch of adjustments for the tax return, is the QuickBooks reporting matching what was done in the tax returns? How clean is this client's books? How accurate are these revenue figures? And then another one is you want to make sure that they're in the same basis as the tax returns, because if they're an accrual-based taxpayer, but they keep their books on cash basis and you're having to do a bunch of adjustments, that's going to screw up the testing, right? So you want to make sure that that's part of it. And then a big one is included with that is are they correctly stated on a quarterly basis? Because a lot of times a common error I will see is that I'll get a set of financials to do this testing, and when I look underneath the data, I can see that there's a bunch of adjustments in the fourth quarter that are going to screw up the testing, because those adjustments, and this is particularly for accrual-based taxpayers, that those adjustments really need to be allocated across the 4 quarters instead of just in Q4 or just in Q1 with a reversal or something like that. And so you got to watch out that they're correctly stated on a quarterly basis. And remember, we're looking all the way back to 2019. So it's not just that 20 and 21 are correct, but that 2019 is correct, because that's the comparative period for both. And then two, with this, I'd say another common thing that's maybe not in this list that you need to consider is that, usually what I do is run the numbers first in the revenue tool. And then as long as there aren't huge swings on Q4, 2020, we're looking for a 50% dip. That's pretty obvious. Usually people aren't having adjustments that are hitting that range. And so you might not need to do a ton of digging on 2020. But that said, for Q4 2020, that if that's 20% or more, that's going to trigger Q1 21. And so, Q4 20 through the first 3 quarters of 21, you do want to have more of a fine tooth comb on that. And then also you need more of a fine tooth comb on 2019, because that's the comparative period. And I've seen some people where they're within, we're looking at, a 7-figure business, and they're within like a $2,500 adjustment that's going to trigger eligibility for them. And so on my side of things, I say, well, we really have to make sure we're going through this with a fine tooth comb, because a $2,500 adjustment is a deposit in transit that's booked incorrectly. So you got to be really careful with it, especially if you're close to the edges of the parameters in either 2019 or, the year that you're looking at. 2020, it's less of an issue, just because most of the time, if people are hitting a 50% decline, that, sticks out like a sore thumb. But 20%, it's, we get a lot more that are closer that way. So you can use the revenue eligibility estimator here. It's a tool that's been programmed. It's got some advice at the bottom, not advice, it's got some recommendations at the bottom of it of what needs to be included. And then just see if it agrees to what was originally filed. Because if you have somebody that filed for an ERC claiming revenue declines, and say, okay, well, let's just rerun this quickly. This is going to take me 15 minutes to pop this out of QuickBooks, pop it into the estimator, and see, does this agree roughly with what the filing is saying? yes or no, why might there be differences? So you can use that. Already talked about the may or may not be qualifying. You really have to watch out for complex revenue recognition. If you've got an organization that's got any kind of complex revenue recognition, getting to the bottom of that and making sure it's correctly stated on a quarterly basis is really important, especially if they're close to qualifying for any of the quarters, or close to not qualifying for any of the quarters. You really got to watch out. And then I already said that. For the PPP, EIDL, restaurant revitalization, and shuttered venue programs, those need to be excluded from revenue accounts for testing. Now, note, I didn't talk about, for a lot of people in the healthcare industry, there were other programs that they were able to do. It's just these programs in particular that get removed for the revenue testing. Other than if there are other programs were loans and not just grants, if they were loans, then, obviously you're not booking that as revenue. But any expenses beyond returns, sales tax, and allowances that were inappropriately netted from revenues for testing. So a common one that I'll see people try to pull is they'll say, oh, well, my cost of goods sold went up really high. So when you net it, we actually lost money. Can't do that. It's got to be revenues. So just make sure that cost of goods sold is not included in there. And there's no expenses that are being part of this testing because that's just not how it was written. And then you also have to watch out for any other regular or special revenue accounts included for the testing. If they had any asset, if they don't normally sell assets and they had a big asset sale, you got to watch out for things like that. Any investment sales. And you want to make sure on the for-profit side that they're net of tax basis when you're going to redo this revenue testing. For the nonprofits, you don't net it. It's just at gross proceeds, but you also want to watch out for that as well, because sometimes in nonprofits they'll have their regular program revenue, but then they'll have a big endowment fund or something like that that's got a bunch of transactions and activity in it, and you actually have to include all that activity on the testing on the revenue side, which is kind of unfortunate because for a lot of the a lot of those nonprofits, they would then use they would sell off some investments in order to pay for the lost in program revenue when they had these impacts, and the net effect is it's going to kick them out of qualifying under revenues a lot of the time. So it's unfortunate, but it's just the way the program is written. And then let's see what else in here. Recovery startup eligibility. You need to consider when did operations actually start versus legal organization. And then just look into the rules for those. If you had an aggregated claim, you need to make sure that all entities have been included for the revenue testing. And then you also need to account for if there's any kind of transfer payments going between entities, because you really have to back up and treat them as if they're one entity when you have an aggregation. So if they're like paying each other for things, you got to watch out for that. And then if you have a business that was not a recovery startup and you see them using Q4 of 21 as a qualifying window, that's a big red flag. That's going to be incorrect because the program ended Q3 21 for almost everybody. All right, so once you do the revenue part, which is, the easy part, then we have to look at government restrictions. And so there's a couple sections in here. This is going to be where most of the bad smelling ERC is. If you have somebody who's qualifying under a revenue qualification, typically because it's easier, people tend to have gotten it right. Now, where I do see this get missed is people who don't understand the alternative quarter election rule. And that's why if you just use the tool that's above, that will capture that rule. And so most likely what you might see in here is people missing quarters that they actually were eligible for in addition to what they filed for. And that's usually 2021 quarters, which is good because we still have, unless, Congress passes this tax bill, you still have another year to go after those. And those are much cleaner. So let's talk about the qualification under government restrictions. First thing is, what's the time period that's being used for qualification? You want to know the exact window and quarters that are being filed for. And then the next question is, do we have PDF copies of government orders for the precise duration of the eligibility timeframe? So not just references to orders, the actual orders themselves, because you need to see the actual language that's on them and the durations in which they were enforced. And a lot of times it's going to be quite a few documents because you'll have initial orders that came out, and then you'll have them getting extended and them getting extended and them getting slightly revised, etc. Depending on the jurisdiction, you might end up getting the state order is going to reference their health board, and then the health board is going to have its own guidance, etc. So it can turn into a bit of a paper wild goose chase. And so if somebody did a filing based on government restrictions, you want to make sure that somebody's done the wild goose chase. It doesn't have to be you necessarily, but if if there's no government orders and you can see on the filing it's, oh, CDC said, like, that's not going to work. You need the PDF orders of Governor X said on order this that my client X could not do this for this time duration, and there's the seal and there's the signature. That's what you need to have. So usually you can tell that if it's a bad provider if you request those and they're not able to provide them to you, because you just need to have them. It's one of the first things on the IDR that they ask for. And then, so once you've got those, does the date range of the impacting orders, when you look at the bottom where it says this order's in effect from this date to this date, agree to the date range of eligibility that was used for the client? Because sometimes you'll have some orders, but then when you look at the date ranges, there's more time period that was filed for that extended beyond that eligibility period for what the actual order was enforced for. And the IRS is pretty specific about, once that order is not enforceable anymore, even if there's follow-through effects, that the client had to, slowly get back on board, or they continued to do the recommendations, etc., not going to fly. You only get that time period where you've got those timestamp orders in place if you're qualifying under the government restrictions. And then, let's see. You want to make sure the jurisdiction's the same. You want to make sure the orders were impacting the organization directly. And a common one I will see is people will say, well, we were really only impacted insofar as our customer demand went down, which is specifically called out from the IRS as not working, or, our suppliers, or, maybe the venue that we were going to didn't work, or things like that. Those aren't really going to work. You're looking for direct impacts on your organization's ability to provide goods and services to your customers. And so it's if it's not a direct order on them, it's not going to be a qualifying thing. Now, supply chain restrictions is different. That piece is a little different, but we'll get to that in a bit. Is the language in the orders binding and specifically COVID-19 related, or is it merely non-binding recommended precautions or suggestions? Because if it's non-binding language, it's not going to work. It has to be an actual prohibition of some kind of behaviors and not just suggestions or best practices. So you got to watch out for that. And the other thing, if you haven't watched my full deep dive on just how the program works in general, I think a quick explanation is we start with the revenues and the periods. Like I mentioned, we start with the revenues and the periods that are not qualifying under the revenue qualification. We then look at those non-qualifying periods to see if we can qualify under the government restrictions. So it's an either or test. And so that's why in the non-qualifying revenue periods, we're going to look for these. And this is mostly going to apply to 2020 because for most organizations, because the 2020 revenue rules were really strict, you had to beat over 50%. Most organizations are not going to qualify for that, and so they get stuck with the government restrictions. And in most jurisdictions, the government restrictions were in place largely in 2020 because that's when the meat of the pandemic was. And so, this is going to be more relevant for 2020. In 2021, this is going to tend to be less of a problem because organizations will qualify under the revenues, and so you don't really have to go looking for government orders because they're qualifying under revenues. Or if they are trying to qualify under government restrictions, it's usually pretty black or white. There's either going to be an order in place or there's nothing, and it's usually quick to find, especially depending on their jurisdiction, because, if you've got somebody who's a lawyer in Florida, chances are they probably never had any kind of qualifying government restrictions, so that's the kind of thing that we're looking for here. And then back to the questions. I'm on number 7. What specific provision in the government order is being used for qualification? You want the actual specific language of the restriction because that's going to be how you make your argument around the suspension of operations comes down to that specific language. So we'll talk about that. Is the entity issuing orders a government or a governmental agency? Do they have jurisdictional authority over the organization? I've had some people where they think that it's going to qualify them, they question if it would qualify them for having a supplier impose restrictions or a vendor impose restrictions, if they normally go to, say, a market and that marketplace is imposing restrictions. The answer is no. It's got to be the government that's doing it, not just your vendor, not a supplier, not a customer. It's got to be a government or a governmental agency. And then does the organization operate in multiple jurisdictions? Because if they're restricted in some locations, but they're not restricted in other locations, is it going to rise to the threshold of being enough of a restriction to be a qualifying impact? And so if they're not operating just in one state, there's probably more analysis that needs to happen there. All right, let's talk about the suspension of operations. So once you've got those government orders in hand, or if you don't have those government orders in hand, that's going to be where you have the hard conversation. But let's say they do produce those government orders for you. What's the thing that you have to look at next? So first is, were the operations fully or partially suspended under government order restrictions? Because if it was fully suspended, easy, right? If they were partially suspended, okay, is it suspended enough to qualify? That's the question. So what substantiating data is being maintained to prove the impact of the orders? Is it just a little bit of a narrative? Is there data? What was actually used to show that the order was impacting them enough? And what kind of data is it? Is it, you can see our job hours per job site went up significantly when we had to social distance, or is it everybody had to wear masks? So what is it that they used, and two, what is it that they use that are actual restrictions coming from the government orders and not just things that they did because the pandemic was disruptive? Because the pandemic was disruptive to basically everybody. What are the specific things that they had to modify their behavior because of the government order, that was restricting them? So when you have partially suspended operations, so just a segment of the business was completely closed, so for instance, indoor dining for a restaurant, are you able to show that at least 10% of the gross receipts or labor hours, when you look at the 2019 activity, was related to that segment for a portion of the segment that's closed? If the answer is yes, all right, then you're good. You're beating that test. If it's not a full segment closure and just an impact, so for instance, having to do social distancing in an indoor dining situation, how is it determined that there was a more than 10% impact on the ability to provide goods and services? Did you have to reduce the number of tables? Did you have to reduce the number of customers that you could serve? Did you have to reduce the number of employees that could work in a space? If you're having to do 6-foot distancing in a kitchen, and then instead of being able to have 10 people in the kitchen, you can only have 5 people in the kitchen, what happened? What was it? And how did it actually change in more than just like it was pretty disruptive? What actually changed? Do you have data related around what changed? Do you have a good case to prove that more than 10% impact? If you can tell that the previous filer was using supply chain restrictions, almost never works. So you want to make sure that they've got copies of the government orders still, also proving that they're beating the nominal impacts. And you want to just review the IRS GLAM that's linked in there with the organizational leadership, because most of the time, if they tried to qualify under supply chain disruptions, vast majority of the time it doesn't work. And so you're walking into a hard conversation with a client. And instead of it turning into a he said, she said situation of, them not trusting you or whatever, it helps to go through the actual IRS GLAM with them and say, this is the actual guidance that we have from the IRS. This is how this works. This is how they're going to be enforcing this. You can see when we read through this together that this is not working for your organization. And this isn't me saying that. This is the IRS document. Read it. So that's why I recommend actually going through the GLAM. Was the employer able to switch to a telework environment and accommodate restrictions? And therefore, they're not going to be meeting the nominal impact requirement. So this is a very tricky little piece of information, because if you had genuine restrictions coming from a government order, but you were able to effectively do your work remotely. So for instance, like us accountants, I was already remote prior to the pandemic, but I know for a lot of accountants, they had an office space, they decided to transition to remote. Even though most accountants were deemed essential in most jurisdictions, office work maybe was restricted. And so they did have to make changes, but at the end of the day, we can do our work remotely. We're not like a brain surgeon where we've got to be there in person. Though I think brain surgery, you can do remote surgeries, because I've heard of people having robotic remote surgeries. But anyway, if it wasn't in person and you were able to switch to a telework environment, then it's not going to work. I see a lot of organizations where they have a sales force where the sales force is largely in person, and they're effectively able to transfer over to a telework environment and switch to phone calls instead of in-person handshakes. And when you look at their revenue performance and things like that, it doesn't make a very strong argument. So you just want to watch out for that telework piece, because I think the IRS is going to hang their hat on it, which, rightfully so. If there's not anything in your data patterns that are showing a more than 10% impact, it's going to be hard for you to make that argument, because I think 10% is a pretty gracious, low threshold. Let's see. And then we're going to have underneath this the operational narrative questionnaire that you can discuss with operations personnel, because the hinge of the argument when you're trying to qualify under government restrictions comes down to, what were inputs versus outputs? What was general pandemic chaos versus true restrictions from government orders? How do you get to the bottom of that? And you have to really talk to people in operations to figure that out, because it's a performance-based metric. It's not necessarily a financial metric. It's an operational efficiency metric a lot of the time. All right, so once you get to that and you've determined the eligible window piece, and I think, the core thing with this is really getting that PDF copy of the order and taking a look at that yourself. The next piece is well, did they actually do the calculation correctly? Now, the first base of that is what are eligible wages, and I'm not going to go into detail on this because I think this is pretty straightforward. Just reading through these individual items, what's going to be qualifying, what's not, what should be excluded, what should be included. Core ones that I see that are common misses is if you have an aggregated claim, you need to make sure that you've caught any employees that need to be aggregated. And then you want to make sure that the wage, if you rerun payroll reports, that the wage bases are basically agreeing to the eligibility periods when you have a non-full quarter. So when people are qualifying under government restrictions, it's the specific time range that was in place. And so you're not going to be able to tie the calculation directly to the 941. So you got to watch out for that. Big one is related party wages. This is probably the most common goof that I see, especially if it was an early filed claim before this was clarified, because this wasn't clarified right away in the program. This was clarified much later. And so if somebody did a claim and they did claim for related parties that should not have counted, you do need to go back and correct that, because it's an overstatement of the credit. So that's the list of people you have to watch out for when you've got related parties working in a business. And then you got to make sure that the family members of majority owners were being excluded correctly. Now, another one that I see a big miss is PPP forgiveness proceeds, just because it's really common. Did they receive rounds of the PPP funding? Did the forgiveness period, how much were the funds forgiven? Does their ERC eligibility window overlap with their PPP forgiveness coverage period? And then you know that you're going to likely have some interaction there. And then you're looking at, do you have overlapping wage bases? Have you considered overlapping wage caps? Because the PPP program has different caps for what you could have used for applying for the financing and then applying for the forgiveness. Like owners' caps were less than just regular employee. I think it's different caps for the PPP program than it is for the ERC program. And so when you do the allocation, they're different. And then also if they used other expenses beyond payroll expenses for forgiveness, the way you do the allocation is going to be different. All right, and then the last piece here is administrative considerations. So when you see somebody that's filed for an ERC, have all their relevant income tax returns been amended? Have they been looked at? And especially you want to look at the state, because some states you'll need to amend, some states you won't. And you want to look for the reduced wage deductions in 20 and 21. Now, if a corrected ERC filing is needed, is there a plan for re-amending income tax returns if that was already done? Because basically you don't want to have them pay extra income tax on a wage deduction that they actually are entitled to if they're paying back ERC money. So you want to watch out for that. All right, last piece here. This is the operational narrative questionnaire, and I'll let you read through this one. But the core piece here is, if you have somebody who's qualifying under a government restriction, you want to know what the operational impact is, because that's really the way you prove that it's going to be enough. And this narrative is just a place to start to help you to collect the right data. So if you found this useful, please share it with somebody else. I'm trying to get this information out to the tax profession so they can use it, because while we have a Circular 230 requirement to assess the reasonableness of claims that we weren't involved in, I think the bigger issue here is we want to make sure that if we're working with clients who did file for the ERC program and we were not involved with it, we want to make sure that it smells good. If you want more of a deep dive, there's an earmark webinar that I do that talks about this. And obviously, we're doing a lot of this work for other practitioners, going through with a fine-tooth comb and making sure that, if you've got a client who's sitting on a 6-figure ERC claim, were they actually entitled to all that money? Do they have a good case? Do they maybe just need some more supporting documentation? What's the situation? But getting them in a position where they're not going to be at risk from the IRS for a major clawback and having to pay significant interest and penalties, because at the current interest rates and underpayment of payroll tax penalties, and depending on timing of these inspections, they could be in a world of hurt. So you want to catch it now while it's a problem that's more easily fixed than, waiting a couple years for it to turn into just a monster nightmare problem. All right, well, I hope you found this helpful. Please do share with other tax professionals if you found this useful, and I hope that you get a lot of use out of this with your clients. If you have any feedback or suggestions, always happy to incorporate it. I just want to get the good information out there for the rest of the tax profession to use. Thanks and have a great day.